Welcome, everybody. I think we'll go ahead and start the program. We have a number of people online, and we know everybody's schedule is packed during PDAC, so we want to try to keep to the schedule. Hopefully a few more people I see are coming in and will join us. They'll just miss a few opening remarks, nothing important. So welcome. We know you have lots of choices during PDAC, and so thank you for joining us here. Us being A&O Shearman, Cynthia Erda-Cassis, I co-head our mining group, and I have some colleagues here from our New York office, Augusto Reloba and Robert O'Leary, and I also have Lachlan from our Paris office, Lachlan Kausty. But we are delighted for the third year in a row to host a presentation by Skarn Associates. Always a fascinating topic and always something new each year. So we have Mark Fellows and his colleague Raymond Philippe, and we also have another one of his colleagues, Kate Cummings, is here somewhere. So who's the chief commercial officer. Ray is our expert on water. And Mark, who I think probably needs no introduction, but I will go through it. He is the co-founder and CEO of Skarn Associates, which is, I think, the market leader in analytics for sustainability metrics for mines, the asset level, and on through the whole chain. Mark has over 30 years of experience providing strategic advice on metal markets, exploration, development projects, operating mines, and corporate development. His expertise includes asset evaluation, benchmarking, and optimization, and encompasses geology, mining, ore processing, and mining finance. He has conducted investment appraisals on numerous companies, mining projects, and the mining sector services businesses. And he and his colleagues identified a niche several years ago, which needed to be filled to provide, the analytics which people had confidence in, and transparent methodologies for looking at these issues. So I'm going to turn it over to you, Mark, to tell us what you're going to cover today.
Thank you so much, Cynthia. I was actually trying to figure out whether it was the third or the fourth time we've done this. I believe it's the third. Welcome, everybody. The idea today, as in previous years, is we want this session to be as interactive as you would like to make it. So at any point during the presentation, feel free to put your hand up. I must remember when somebody in the audience asks a question to repeat the question for the benefit of people online. So if I forget to do that, will somebody please make sure that I remember.
And Mark, sorry, not to interrupt you, Mark, but anybody who is online who wants to ask a question, just put it in the Q&A function, and I'm watching my computer, so I will raise it to you.
Thank you very much. If you don't mind, I think there's not so many people in the room that this turns out to be a bad idea, but I think it'd be great if everybody could just tell us your name and who you're with. I think that's a great thing. So Raymond.
Yeah, Raymond Philippe, head of water at Skarn.
Lori Kelly, I'm Chief Sustainability Officer at Brazilian Nickel. We have a nickel project.
Some books in Mines Finance.
I'm from Decarbonisation at Valley Base Metal.
My crew and consultant with A&O.
Evans, Director of Single Mine Origin, based out of the UK.
Marine Spelonge, Chair of the ESG Committee at the Queen.
Yeah, let's go there. Excellent.
Are you my
Great. The blonde lady in the corner. I knew that. Thank you.
Rob O'Leary, partner at A&O Shearman in New York.
Okay.
Brian Robson, partner in this office. Martin Field,
Great.
All with respect to Tulsi based in South Dakota, but also am organizer of the Enrichment of Mining Finance Conference in New York in May, hosted by A&O Shearman in New York.
Right, plugged in. Thank you. Chris?
Chris Middleton, he was brought up to
Morning, Andrew.
I'm Simone Bailey. I'm with WSP in the mining water stewardship.
I'm Rajan Shah. I'm with WSP, Mining Water.
Lachlan Kowski, A&O Shearman. Sajid Bender, decarbonising lead for.
Yeah, Mark Isto, I'm retired from Royal Gold, consultant for.
Catherine Berger, I'm with Artemis Capital Advisors.
I'm Jared, we've got Artemis Capital Advisors.
Thank you. Fantastic. And I'm already thinking there's a couple of people in this room who I know need to speak to each other, so I'll try to remember that if we do.
We also have about, I think we probably won't ask them to introduce themselves,
No.
but about 25 other people on the line. so.
Welcome online as well. Thank you. So, thank you, everybody. That was great to get a feeling for the range of people in the room. The idea today is we'll be speaking or planning to speak until around 10. Raymond will be up first to talk about water. Raymond has a PDAC event to get to that he's speaking at immediately after this, but we should be okay for time. And obviously we're happy to take questions afterwards and follow up by email, however you need to do this. So thank you, welcome. The general agenda for today then, and that's obviously, Raymond's going to talk about the role of water in metal supply chains. I'll be then talking about decarbonisation trends as we see them right now. Where are we? What's been happening? Where are we making progress? Where are we not making progress? And then I'll be moving on to talk a bit about some of the research that we've done for our quarterly product, the Decarbonisation Quarterly, looking at company decarbonisation pathways in a lot of detail, looking at progress to date, what's still left to do, and what are the risks associated with that. So that's the high level running order. As I say, we're aiming to do this fairly interactively, so please feel free to raise your hands. Raymond will be talking for about half an hour on water. And but before we get into this, key issues. There's a shift in water. I won't spend too much time on this, but financial water metrics are obviously a key thing, and we've got some interesting views on our own versions of those metrics. We are actually seeing emissions intensity increasing so far, or at least the volume of emissions increasing year on year still. So we'll talk a little bit about what the implications of that are for targets out to 2030 and 2050. There's a lot of differences from asset to asset, mine to mine, commodity to commodity in terms of what the key drivers, issues that we need to think about in terms of decarbonisation are. I'll get into this when Raymond's spoken about water, but I also wanted to put some global context on the sector relative to what we're seeing in emissions trends across the board. So on that note, I'll hand over to you, Raymond. And
Mark, one thing we might want to just note for people who ask questions, we are recording this session so that it can be shared with participants and others. So just in case that's relevant to the question.
Morning, everybody. Thank you for being here. For me, it's the first time to present things on water here at PDAC. And I'm very impressed with the room, and especially the miners are in minority. It's the financials right now. I think that's one of the trends that you just also mentioned. So there's a new view on how to evaluate to look at water. It's not only an operational issue, an ESG and emissions issue, but it's becoming every time more a financial risk management issue. That's going to be a focus on this. I think I have 7 or 8 slides or so. I have 30 minutes. Going to go through them. Please raise your hands anytime you want to. Pretty dynamic. So first, what we do and how we do it, and a very brief overview. We do quantified asset level water use data analysis. And what we want to establish with that to be a single source of truth on all the water data that's out there, and from what's happening at the mine, and convert it into data for production, for output, for finance. So that it's the same data set at the end is usable and useful for different stakeholders in this. How we do that? So we use the production database. It's the same database that's being set up for the GHG products. We develop through our own methodology asset level annual water balances. We do that from 2018 and we project it forwards to 2030. We include as well in that whole analysis asset level operational context. I'm going to into that a bit more detail. And we use georeferenced historic and now also future climate data. And with that, we can take also some, we make some estimations and insights from there. And the output of what we do is we have we get indications of how water is being used for production and for finance associated to that. And what used to be, I would say, the traditional way of looking at water is from an environmental impact. And what we are seeing is that, especially from the kind of people in this room right now, there is every time more focus and drive towards the mining companies in understanding or making understand how water is being impacted or how water is being a risk factor for the business, for the mining companies, and as well for the financial sector that's supporting that. So that's where we are, hopefully in the middle. I'm going to go through a couple of exercises, examples, mostly related to copper, because I think at this point, that's where the stress is the highest. And the data associated to it is more, on a global scale, more relevant. So first of all, net zero as a statement, net zero is water dependent. And it's not only, it's a full circle. To get to the critical minerals that you need for net zero and net zero emissions, you're seeing climate change happening, but your climate change is directly affecting also water security. And water security is needed to provide for the critical minerals. So how do we break into that circle and make it happen? That's effectively the additional amount of, in this case, for example, copper. How can that be provided in the future? And what are the effects of that supply for the water requirements and water supply? If we take the IEA numbers for 2030, there's an estimate of an additional 18% compared to 2023 base of additional copper that is being required. But we are already seeing in copper that 40% of copper mines globally are already with a certain level of at least 5% of their current production capacity at stake due to drought, or mostly drought related issues, but also sometimes flood related issues. Mike.
Would you be able to get a little bit more granular when you say 5% of the production is at risk of drought or flood related? Is that going to be the concentrate? Is that going to be workforce related? Is that going to be logistics after the fact? Or is it going to be the mine shutdown if there's...
So the methodology that we have on that, I will show some examples, but the methodology behind that is that we, based on each of the mine's operation setup, we know how much water is required for consumption to produce the output that they have in mind. And what we can do through, I'm going to, in the next slide, I'm going to into that. I'll get to that. But basically, with the current setup of copper mines out there and processing capacity out there, currently we see close to 7% of the global copper production capacity is at risk of not being used for copper production, basically because of drought, mostly drought, and sometimes in some areas flood. We shall also see that climate change, and I'm going to show that also in a slide, is altering water availability and water management at site. And this is a trend in mining. That's the nature of the beast. Declining ore rates, and especially in the case of copper, what we see in several areas. Chile has gone through that most of their operations, but some regions will have to face that as well. When they go from oxide processing to sulfide processing, that will require additional water. And the question is that water going to be available for those operations? And the case in the new mining projects, challenge to obtain permits, social license for sustainable water supply. So, and this very often relates to, for example, the technical reports, 43 101s, and there is an identification of water requirements. There's very often an indication of water, in theory, available through water rights, but physically it may be not there, or it is not available because it's already being used for other users, and so you're having this conflict issue. I'm going now to Michael. This is a bit relates to your questions on the granularity. So what we have here, how we analyze this, the local context, water use at the mine site depends on a lot of different factors. Mine type, process type, the size of the operation, the climatic conditions, the efficiency of the operation in its recirculation, the sources of water is a big factor in the water use evaluation. The potential for the discharge recirculation, not all the mines are recirculating, are just a pass through, for example. Once they get to a recirculation, they also reduce their exposure to external water availability risk. Decisions on operational aspects around waste management, mine dewatering requirements. To get to the ore, you need to have at least either the pit or the underground have to have that dry, and you have to manage that water. Land use, precipitation, there's a lot of stuff going. If we have the right side, we have a graph, a variable width graph, 19 million tons of copper production globally, 2024. And we have identified for each of the operations, right, it's pretty obvious who that is, because of size. On the vertical, you see the total validated water consumption in megaliters for 2024. And on the 19 million tons divided in 220 assets approximately, you see the split of the different water sources that are being used at each mine. And not all the water sources have the same water risk associated to it. So surface water typically is much more exposed to climate risk than groundwater, for example. And in the case of the desalinated seawater or direct seawater or the wastewater recirculation options from other water users, you're basically independizing your exposure to climate risk associated to. So we have the ability now to for each of the mine sites to identify how much of each water sources come from which, and to quantify associated to that the risk associated for production. That's a bit your question. Questions on this one?
Yes. What asset is the one on the far right?
That's Escondida. So interestingly for Escondida, so they have 95% of their waters coming now from desalinated seawater mostly, and they still have a dewatering effect from the further pit for access. To make that happen, they invested more than $4 billion
In desalination.
Yeah, that's a desal plant. By applying the energy supply to that.
What is the energy source?
I think they just signed a PPA on them.
Yeah, they've decarbonised their grid supply massively by taking advantage of some of those power purchase agreements that are available in Chile over the last few years. So if you look at, it's really interesting actually, cross-cutting question. If you look at Escondida's position on the carbon intensity curve relative to the rest of the copper mines around the world, it's gone down from around the 70th percentile to the 25th over the last 3 years. So transformational stuff, both on the water and the emission side.
So this is the picture of 2024, and you see already a couple of operations that are using, I would say, alternative water sources, not direct continental virgin water. And we see that especially in Chile now in 2026, several of the desal plants are coming up, and that will shift a couple of things to show that in this one. So what we then did here with the incorporation recently of forward-looking climate effects on precipitation and water availability at site. So the thicker line in the middle represents global production at risk. That's the aggregate of all the 220 something assets that we are looking at. And not all countries are facing the same production risk. So we have now from 2024 to 2030, based on the production that is projected and from the climate change using a SSP 4.5, that's the middle of the road forward-looking model. We evaluate what the risk associated to water production, to copper production is. And there are a couple of interesting things here. As I mentioned, the red line here in 26, this is Chile. You would expect that Chile would be pretty relatively high in production risk. This is the coming online of Bronces, Codelco Norte, Collahuasi, and that will decline production risk for Chile as a country. On the right, you see the number of operations that we have taken for each of these countries that you're seeing here. Indonesia, for example, it has almost no water production risk, really. There's sufficient water, it's more of a flood risk, really, and it's climate independent, almost. But there are a couple of countries that are facing, especially towards 2030, an increase of their production risk. And what struck me especially there is Australia. Peru, it's still very high, but it's going down, but that relates mostly on the lack of the forward-looking projection of production. So once they maintain production as they have it right now, that line would go. And another one I'm pretty, I would say, worried about is the greenish line, United States, because still these are mostly the oxide operations. Once they go to sulfide concentrators, that will go very steep up, especially in the locations where these mines are operating, Southwest US. Where will they get their water from? And if they don't get the water, they don't have production. Questions? No. Next. Looking at it at a company level. So what we did here, same looking at Codelco, at the copper. All the assets, split them up. The very good operating at 0% and the very bad at 100%. And each of these bars, the yellowish bars, represent the best and the worst operating asset for each of the mining companies that you see on the right. And these can be pretty wide as a bar. So if you have an average value for a company, it not necessarily means that that company is affected or non-affected by climate risk or production at risk, or is doing well on all the assets on environmental water-related issues. That's one thing. The other thing that we've included in this one is the split, if any, on production owned versus production operated. So typically, if you're looking at the sustainability reports of a company, that's typically expressed on by the operator on a 100% basis. But that's not necessarily the financial impact. Interesting one, for example, Rio Tinto. So their operational water consumption benchmark is relatively low, but on the financial benchmark is much higher, and that relates to the 30% of Escondido. Sorry. So that split you wouldn't see in the sustainability reports, and it's not connected by the mining companies when they report on in alignment between the financials and the sustainability values. There are some pretty interesting things to be seen. Questions? Comments? No? Going to my last question. Much going too fast. Different thing. So we're not looking only at copper, other metals as well. And we're looking at, we have done an exercise on what does it mean for the OEMs, the metal off-takers, how they impact water at mine sites, basically. Where do they get the metals from? And what is that? What does that mean? And is there a thing to be told, a story to be told? We did an exercise here on a an EV vehicle with a composition of the metals that you see in the table in the middle. So it's nickel, cobalt, lithium, nickel, copper, lithium, cobalt, aluminium, steel, manganese, and assembly costs. If you're looking at the sustainability report of the car companies, they typically only report on and compare on the assembly related to water use there. So the 3 cubic meter per vehicle.
You're not talking about
That's it. And then you have the good ones and the bad ones. It's between 2.5 and 4-ish, and that's it. However, as you can see, that only represents about 10, 11% of the total amount of water if you're taking the averages of water consumption for each of the metals that are contained in the car. And the most of the water, again, on an average basis, is related to nickel, to copper, lithium, and cobalt. I put those on the right, lithium, copper, nickel. Cobalt typically goes together with copper or with nickel, so it's somehow inserted in there. And what you can see there on the graph on the right, the dark red bar represents I would say the best operator or the best values, the top 20%. And the pink bar on top of that is the range between the best operators and the worst operators, and how that is a difference that is can be pretty significant. In the case of copper, for example, what we saw before, there is a difference if you're looking at the intensities. Can be 4 cubic meter per vehicle that you would need. That's for 53 kilos in a good operator, and from a consumption point of view, and from a less managed water consumption view, it can be over 11 cubic meter per vehicle. So that's in incorporated water for the production of a vehicle. With new regulations related to reporting, especially from Europe now coming up with CS3 DDD and CSRD, those are views that are being developed right now. It's being a bit delayed now, but it will come at some point. The main one, though, is nickel. And depending on the type of process, the location of the process, is the sulfide, it's an HPAL operation for nickel production, you see a wide range of water consumption intensities. And that might move the needle a lot for the overall water consumption integrated within the vehicle production. And that's a bit what we have been doing work on so far.
Does your analysis take into account the fact that cobalt is most often, kind of, it's a byproduct of nickel mine and copper mine?
Could you repeat the question?
Yeah, sure. The question is, if we take into consideration that cobalt is being produced very often as a byproduct from nickel and copper operations. Yes, we do. The way we do it is based on the financial impact. So we have the intensities. We calculate that on a direct cubic meter per ton of copper produced basis, for example, or cubic meter per ton of copper equivalent. And that would include also the byproducts there. We just, for example, we released last week a new product that's the silver curve, where we have about 350 assets covered producing silver. The challenge there is only 10% of those mines are primary silver mines. So how do you prepare, where do you get the data from? For if you're interested in silver, how do you evaluate your impact on silver production? But you can do that in an indirect way on the financial impact. Similar as what the royalty and streaming groups doing with the equivalent version of the byproducts.
Would this slide look much different if you were looking at the average water consumption for a combustion engine car? Is it very different between combustion and EV?
It does, basically because of the battery. I'm not sure if we need to repeat that, or that's
That's really
No,
okay. the difference really is in the metal components in the battery, and that's the nickel, the cobalt, so the copper, the wiring associated to the copper. So that is what most of the water is.
So for an EV, you're going to show greater water consumption than
Yes.
for.
An interesting point here as well, lithium. And there's a lot of discussion going on there. Depending on the processing route. In fact, the International Lithium Association right now is working on water footprint guidance, this development, and how to differentiate and define what is water. Is brine water or not? Should it be reported differently? Should it not be reported? So there's a lot of discussion going on in that group working with the guidance. Sorry.
I mean, with copper, so a lot of the copper mines are investing in desalination, technology. It's obviously quite costly. Have you done any analysis yet on what might cost on?
Repeating the question. So the question is whether we have done analysis on the incremental costs for water supply for copper with the incorporation of desalinated seawater, for example. We have done an exercise, in fact, for a client some time ago, where I did a conceptual study for a group of copper mining operations, what their conceptually what the cost for CapEx and OpEx would be if they would convert all their water supply to desalinated seawater. And that's basically associated to, in a very broad way, associated to the altitude and the length of the pipe. All the other factors are more or less under control. There are some business contracting issues associated to it. So who is the owner of the water supply system? If it's a mining company, you would expect a different IRR than from a water supply company or a water infrastructure company, and that affects a bit of the analysis. But in general, the intensity costs per cubic meter of desalinated water produced per day, that's a standard. So it's about $1,500, $2,000 per cube per day, something like that in a desal. Then you have a bit of upfront costs on the marine works, and then it's the pipeline. That's also, and the complication there is mostly on the routing and the social part.
How do you capture you mentioned social aspect, how do you capture that cost in our analysis?
The question is, how do we capture the social aspects in our analysis? To be honest, we don't. The quantification of that is very tough to do, and especially then do the comparison between different regions or different jurisdictions and different. It's a kind of works. We have not gone into that, nor have we, for example, gone into, I would love to, the water quality issues, because that's also very local.
With the rather significant range that occurs in nickel, do the same type of trade-off studies occur to look at the water source, desalination, groundwater?
In nickel?
Yeah.
In nickel, depending, short answer, no. And the reason for that is that the majority of the nickel producers, the laterite producers, are in the tropics. They have always an excess of water. And not only that, because of the extension of the operation, they capture a lot of water. They capture much more water than they need. So they have to discharge. Rainwater, typically rainwater. Mm-hmm. In Philippines and Indonesia, you have to dig in 30, 40 meters, get a couple of meters out, and the rest keeps it is still exposed. Takeaways. So, as I mentioned, water is affected by climate change and is a resource required for net zero critical minerals production. 2024 globally for copper had just under 7% and is growing to over 9% in 2030 based on the production projections that we have now. Both metal supply and demand are water dependent. And I think this is for a lot of the people in the financial sectors, in marketing, within the mining companies, this is relatively new, and they are starting to look at this. Myriad of new regulations, and this is a headache and a lot of stuff going on. It's every week nowadays, the omnibus, what is happening, what's not, what's staying, what's delayed, how is the alignment going on, how is different standards, let's make a new standard. There's a lot of stuff going on, but most of those standards relate to disclosure for compliance and not necessarily for financial impact. So at the end, what makes sense is, at least from a financial economical point of view, is to look at it that way. Is it material for you? Then you probably should have a look at it. There are great asset level water impact differences, and that has first its effect on the mining operations itself, but then also on the financial sector support. And with that, the financial sector is directly exposed. Final questions?
One final question for you. It's interesting, the difference between nickel and copper.
Yeah.
That copper seems to be in places where water is scarce, more often than not.
Yep.
And nickel where water, there's too much, arguably, in some cases. That has to have very different financial implications. I mean, one is, how do you manage having too much? How do you manage not having enough? The solutions are different and the costs are different.
And even more interesting, and it's something that's starting to happen in Canada, for example, where you have both things happen at the same time. In Peru, for example, a lot of that. Some regions in Brazil and in Australia, where you have months that you have an excess of water and you have months that you have a lack of water. So you have to be prepared for both.
Mm-hmm.
And 1 year to another may have a lot of difference as well there. So that's the mitigation of buffering effects and the costs associated to that. That is that's not always with it. So.
Raymond,
Am I doing in time?
You were bang on 30 minutes, pretty much.
I did.
So, that's great. Thank you so much.
Thank you.
Raymond, I'll take over. So thanks a lot. So the rest of the presentation, we're going to focus on greenhouse gas emissions and decarbonisation. The first section of this will look at the current state of play, if you like, and the industry footprint as it currently is, and has that changed in recent years. This is our breakdown on global emissions from base, precious, and bulks. So we're not including aluminium in this simply because it blows everything out. It's so massive. We saw emissions increase from the sector last year. These are still somewhat preliminary numbers while we wait for the reporting to come through for 2024, but it looks like we had a 2.5% year-on-year increase from these commodities. So that's copper, lead, zinc, nickel, gold, silver, iron ore, and met coal, and lithium. I wanted to put that in a bit of global context, and excuse me, Sat, for repeating some of the stuff I said on Sunday at the decarbonisation conference session, but to put a global picture on this, back in 2020, fuel-based emissions globally, so this is excluding land use change emissions, were around 34 gigatons of carbon from fuel use across all sectors. In order to be on target for net zero in 2050, we'd have to be aiming to get carbon emissions down to around 21 gigatons in 2030. So 34 down to 21 over the course of 10 years. Last year, the estimates are coming in at 37 gigatons. So we've gone up in the interim. It means we've got a 40% reduction to make before 2030. So as a global economy, I don't think that's going to happen. To be state something quite obvious, really, that is not going to happen. So our sector is obviously unique. It's got its own set of drivers. But on the face of it, this doesn't look great. And it looks like we're increasing emissions in line with the global economy as a whole. The interesting thing is that so far we're not seeing an energy transition so much as an energy addition. So we've seen record coal and oil use in line with that increase in emissions. So rather than seeing those hydrocarbons being reduced, they continue to grow. A lot of that is driven by the electrification of developing countries, and coal is an easy option if you want to put up power generation capacity. So we're still seeing coal use go up massively in places like India. And the other point I made on Sunday, which I thought was really struck me, is if you look at the developing world, you've got 3 billion people who use less electricity every year than your refrigerator. Okay, on average. Some of them are not using any electricity if you're living in a mud hut in the middle of Africa. You've got no power. So this headwind partly comes from that energy poverty that's got to be addressed. People need electricity. So that's the global picture. It's easy to conflate that with the idea that maybe we're not decarbonising at all. Maybe this is all just smoke and mirrors and nothing's actually happening. But that doesn't stack up if you look at the amount of capital that mining companies have committed to this. And also, one of the points I'm going to come on to as we go through this is that the mining companies have so far looked for things they can do to decarbonise that are effectively cost neutral or NPV neutral to them. And that's been a huge underpinning to the decarbonisation plans that they've put in place so far. We're coming to a real switch point around 2030 as some of the easy gains on decarbonisation that the mining companies are making in the meantime start to disappear, and you're then into more difficult scope 1 decarbonisation. So it's a very nuanced picture. The other things I wanted to highlight on this slide, a big chunk of the scope, well, a big chunk of the emission comes from the downstream in the base metals, particularly nickel and nickel pig iron. So where we have all of those RKEF plants in Indonesia churning out ever increasing quantities of nickel pig iron, that is in itself adding significantly to the emissions total. So we'll see that as we move on to the breakdown by commodity. We've got a waterfall chart here showing what happened between 2023 and 2024. And the big, let's see if it's a, sorry. The big increments here are a big uptick in what we're recording from methane emissions from metallurgical coal mining, and partly that's a methodological change and a bit more stringent quantification of some of those fugitive emissions from coal mining. We're actually seeing that nickel pig iron production adding just over 2 million tonnes to that delta between 2023 and 2024. So the next most significant component. Interestingly, the gains we're seeing in terms of emissions reduction, it's all coming from scope 2 reduction, showing here on the base metals and precious metals, as the mining companies are implementing those power purchase agreements with lower carbon electricity supply where they can. But really, that is the only significant improvement we're seeing, along with some improvement from the installation of renewable energy at mine sites where the mine is generating its own power on site. Not a particularly positive picture overall. Lithium, despite the fact that the lithium market is still really tiny in volume terms in comparison to the other commodities we're covering here, we can see that there's a fairly significant, nearly 1 million tonne of additional carbon emitted from the lithium supply chain. Most of that really relating to the mineral conversion of those lithium spodumene concentrates into lithium carbonate, which is an energy intensive process and uses a lot of hydrocarbon. So those are the key drivers underneath that year-on-year change. We zoom into copper. We can see here that over the last couple of years, mine site Scope 1 emissions from the copper mines have remained relatively stable, and we've actually seen a reduction in the Scope 2 emissions. So that power purchase agreement effect has been really prominent in the copper segment. There's also an effect here whereby we've seen production growth from some low carbon grid locations like DRC. DRC's power supplies is hydroelectric, so very low carbon. And as we see production volumes increasing from those locations, we do see the Scope 2 number coming down as well. This Scope 1 emissions intensity and the difficulty in reducing that is going to be one of the key deciding factors and headline issues going out to 2030 and beyond. So we're seeing that combination there of power purchase agreements and to some extent renewable installations bringing Scope 2 down. Scope 1's another problem dealt with. So this slide just making that point really that we've seen Chilean emissions come down massively as a result of those PPAs. We obviously think in terms of those countries which have relatively clean grids like Canada, Sweden, Australia. There's a lot of interesting things happening there with their electricity grids. I say grids in the plural in that they're isolated from one another given that it's such a large country. But there is a tremendous amount of decarbonisation happening in Australia over the course of the next 4 or 5 years, and that's going to have a fairly significant impact. Again, more of a gold issue than a copper issue, but South Africa's coal dominant electricity grid is one of the reasons that their gold production has such a high carbon intensity. So if we look at this on a commodity by commodity basis, you can see that certain commodities have a much higher exposure to grid power than others. Gold sector, around 74% of gold production, formal sector that we cover, is connected to the grid, which is somewhat lower than the copper miners at 92%, and the coal mines that we cover 100% grid connected. So it really depends what the geographic distribution of the mines is and what the grid emission factor in that location is. So I mentioned Australia there, it's currently around 0.7. I think by the time we get into the early 2030s, that will have fallen to around 0.35. So effectively a halving of Scope 2 emissions intensity for those Australian operations connected to the grid, and some fairly significant regional variations in that emission factor within Australia itself. So a fair amount of detail to think about there. Obviously, a grid connection, if that grid is decarbonising, is tremendously helpful. A grid connection, if that grid is not decarbonising, is a problem, and that's the issue, for instance, with that. Yeah. Please interrupt me if you have any questions as we go. I'm very happy to. So looking at the split of emissions from copper supply chain broken down in a bit more detail, the key point I wanted to get over here was that effectively a big chunk of those emissions, so about 1.2 tons of CO2 per ton of copper production out of a total of around 3.5, 4, comes from smelting and refining. A lot of that is in turn linked to scope 2 grid emissions, in that the copper smelters and refineries will almost entirely be grid connected. So I think it's still a process whereby smelting and refining companies are getting to grips with their opportunity to decarbonise, if you like, and are somewhat behind the miners in that regard. The miners have already implemented a lot of those PPA contracts that we've been talking about. The other big component that's going to, as I say, need addressing post 2030 is that mining fleet emission. That's obviously mostly diesel use from mobile equipment. We're at a very interesting point right now whereby we're seeing a lot more solutions being offered in terms of electrified mining equipment. On the underground side, that's already quite well advanced, and a lot of equipment options becoming available, with the big gap still to be filled mostly on the haulage side. So large underground truck availability is still an issue with regards to electric equipment. On the open pit side, we're seeing a lot of money being invested right now in JVs between the mining companies and the equipment manufacturers in order to develop these battery electric or trolley assist, some kind of electrified fleet solution. So that's going to be the focus. Moving on to gold, slightly different story in that we're seeing a big impact here from increasing production volumes. There's a general trend towards grades falling, ore grades falling, but ore volumes processed increasing. Obviously, that has a significant impact on the energy consumption per ounce of gold produced. So what we're seeing here is that as that energy demand increases, we're seeing the emissions intensity going up as a result of that grade fall. We're also pointing out the fact here that if you look at scope 2 emissions from gold mining globally, 43% of those scope 2 emissions actually arise from South Africa, which is by no means the largest gold producing country these days, which makes it all the more noticeable. South Africa continues to battle with policy and investment to get the state power company Eskom to reduce its emissions. In terms of copper gold producers, you're seeing the knock-on effect of some of those PPA agreements that I mentioned impacting the copper mines, following through to some of the gold mines as well. So the scope 2 reduction is a bit more noticeable for those. This is just another way of looking at that issue I was mentioning. We're seeing ore process volumes going up. We're seeing gold production remain relatively unchanged from the coverage universe, and the net impact of that is that we're seeing the emissions intensity rising, partly offset by scope 2 emission factor reductions. Downstream emissions in the gold sector are pretty much immaterial relative to the upstream scope 1 and 2 from mine production. So we don't tend to have an awful lot to say in terms of the emissions associated with freighting your doré from your mine, refining that. Those are relatively insignificant. The point we wanted to get across here was that mine fleet, so this big blue block here, dark blue block, and self-generated power are larger percentages of emissions for the gold miners than they are for the copper miners. Scope 1 issues are very similar in that gold mines and copper mines tend to have fairly similar scales of mine and similar mining methods going on in terms of both underground and open pit. Lithium, let's get this to catch up. The story with lithium has been driven by the growth in hard rock lithium production. So on the graph here, what you can see is lithium production from 2018 out to 2030 forecast. The pale blue bar at the bottom being production from lithium brine operations, and stacked on top of that in that pale purple colour, we've got production from hard rock spodumene producers predominantly. And what you can see is the vast majority of the production growth that's happened over the last 4 or 5 years, and the growth that's projected over the next 4 or 5 years is from that conventional or hard rock source. That hard rock production has a much higher downstream emission associated with it than the brine producers. So as you ramp up that hard rock production, that hard rock concentrate gets sent to a conversion plant where it's roasted. That typically uses quite a significant amount of natural gas, plus there's some quite a lot of electricity going into that process. So really what we're seeing with lithium is the emissions intensity increasing fairly substantially as we see that switch from the relatively low carbon 2.5 tonnes of CO2 per tonne of lithium carbonate equivalent to the conventional hard rock, which overall has around 14 tonnes of CO2 per tonne of production. So a big contrast there. In terms of the future, that distinction between the low carbon brines and the high carbon hard rock will continue to be a driver. Conversion processes and converting those to something that's less carbon intensive is going to be key to this. Hydrogen is one candidate for decarbonising that spodumene conversion. But what we see from the analysis we've done on other downstream segments for, say, copper, is that if we look at the substitution of hydrogen for natural gas in those processes, there's a relatively limited opportunity to implement that right now, largely down to availability of hydrogen. When we look at the costs, those are almost a sideshow relative to the fact that actually sourcing some hydrogen in the first place is going to be your first problem that you've got to overcome. So I think in terms of downstream pyromet processes across the commodities, hydrogen availability is going to become a very interesting bottleneck over the next 10 years. So from there, I'm going to move on to talking a bit about decarbonisation and how that's developing. Having set the scene and shown you where we are on a commodity level, and what I'm going to go through with you now is some of the research that comes out from the Skarn Decarbonisation Quarterly, which is a new service we launched back in September. The idea being that there was now a lot more information available from the mining companies themselves in terms of how their decarbonisation pathways are unfolding. We decided that there was a real requirement for somebody to take all of those very differently presented decarbonisation pathways and try to make sense of those and try to do some comparative analysis. So we've been working on this now for well over 18 months. It's developing into a very interesting, rich research library, basically. So what I've done for this presentation is I've taken some of the content and I'll go through highlighting some of the issues that we're seeing come together as trends amongst the mining companies. So this is a set of some of the companies that we cover. What we've done here is we've tried to characterise their emissions reductions targets, both the near-term one and the 2050 one, looking at what kind of percentage reduction they're aiming for, and also what kind of target is it. So targets get stated on very different bases, and what we've done here is we've colour-coded them depending on whether they're on an absolute tonnage of CO2 basis, an intensity basis, and what kind of percentages are they aiming to achieve over the course of their target period. How do they consolidate the numbers when they state them, and are they including scope 1 and 2, 3 in their targets or not? So just a way of characterising those. You can see that there's some quite significant contrasts between the different the ambition of companies' targets. Codelco, you'll see there, is putting forward a 70% reduction from their baseline year out to 2030, and it looks like they'll achieve that. Again, almost solely through power purchase agreements. And then at the other end of the scale, we have some companies with sort of 30%, 15, 25, 30% targets. And these things tend to be driven by technology and economics, of course. So one of the points I wanted to make is that so far mining companies have tended to base their targets on what they can achieve from a cost neutral point of view versus business as usual. And I think there's also been a fair amount of refining and revision of targets over the past 4 or 5 years. And we've seen some of the less realistic targets get pulled back and revised down. So if we then look at some of these companies in a bit more detail, so this is a bunch of copper miners. What we're showing here on the left-hand side is the range in their emissions intensity across their suite of assets. So if we look at, say, Glencore, they have copper mines which fall at the lower end of the carbon intensity curve, also mines right at the top end, and the corporate average sits somewhere around the 40th percentile. The point being that in some cases, the average carbon intensity for a mining company is actually not really giving you a very clear picture of what the range of intensities from their various assets actually is. So there are instances here where you have, say, KGHM, all of their assets sit towards the top end of the carbon intensity curve by virtue of the fact that they're deep, mature, hot, coal-fired underground mines with a high ventilation and cooling requirement, and barring any decarbonisation of the Polish grid, it's difficult to see how much progress they're going to make on their decarbonisation. But the point being that there's substantial ranges either side of the company average. So what we've done, and these are 3 anonymised examples of actual pathway analysis that we've carried out. And we've done this for around 20 companies so far. So for each of the companies that we look at, we aim to arrive at this kind of waterfall analysis. And what I wanted to get across here was that the route that companies take from their baseline target to their from their baseline position to their ultimate target looks very, very different depending on the nature of the assets. So what we have here with company A is a company that sees most of the gains that it makes in terms of carbon intensity offset by organic growth in the portfolio. So as production increases, they've got a natural headwind that's actually going to see their emissions number creep back up relative to where it is now. And this is another theme that we see playing out through all of the companies we look at, is that the baseline that they're basing their emissions targets on gets revised quite frequently. And there's that huge effect whereby companies tend to have a target or a pathway that looks okay on an intensity basis, but when you factor in the production growth, that gets more than offset, and on an absolute basis, the emissions are actually going up. Company B, that's stating their target on an absolute basis. They've got one primary initiative, which is essentially implementing renewable power through PPAs, and that ultimately gets them more or less to their 2030 target. Company C, they are in the unfortunate position where most of their emissions are in the scope 1 category, and they're hard to abate. So that will be everything from mobile mining equipment, diesel use, but also some process emissions. Consequently, that leaves them in a position whereby when you factor in that organic growth, their target doesn't look too much different from their baseline. So depending on the asset mix, depending on the availability of technologies, it's going to really drive what this decarbonisation pathway looks like. So just to give you an idea of how we approach that within our research, this is an example of Farley. Obviously, a lot of words, I'm not expecting to screen all of those. What we do is we go through and we look at the existing emissions profile, broken down in this case by commodity. We look at how that's how the company's posing to address that, pick out the key initiatives, trying to understand what's currently in the baseline and driving it, and then we get to that that analysis of the decarbonisation roadmap. And in the case of Farley here, the majority of their emissions reduction in the target is planned to come from a fuel switch, mostly towards biofuel. And then there's a big offsetting number there in terms of organic growth from production that's going to offset a big chunk of that. So that's the way we approached it for 2022. We also see some unifying factors start to emerge from this. So as you've heard me say several times over now, renewable power purchase agreements are pretty much a key lever across the board. There is some amount of mobile equipment decarbonisation going on in all of the company's plans, although it's not, generally speaking, one of the main levers to decarbonisation yet, although it will need to become one in future. All of them are looking at some kind of fuel switching, many of them towards some kind of biofuel, switching away from coal to natural gas within processes where they can do that. And the other big unifying factor is that everybody's got some kind of optimization and efficiency initiatives going on. A lot of that may relate to things like automation, better process control, better operational management generally. Looking at the economics of some of these decarbonisation levers, I wanted to give you a summary here in terms of how those things compare in terms of their state of development and potential for providing decarbonisation. If we look at renewable energy, we've seen massive reductions in the unit costs of solar and wind over the last, solar particularly, over the past 10 to 15 years. We're seeing obviously pretty widespread adoption of that across the industry. What we do in the background in our research is we've databased, I'm not sure what the numbers are, but I think probably something like 170 asset level decarbonisation initiatives, and started to benchmark those in terms of unit cost, technology provider, scale of carbon reduction, all of those key metrics for each of those decarbonisation initiatives. So we're databasing all of this stuff in the background and trying to get a handle on what the economics looks like. Bioenergy, as I said, fuel switching is a big driver for many of the producers, and one of the few ways they can start to make some inroads on their Scope 1 emissions. Bioenergy is a pretty immature but rapidly evolving market. But what we're seeing is that the availability of biofuel, particularly things like a drop-in renewable diesel product that can easily be blended with a standard diesel, the availability of those things is very locally dependent. So some parts of the world are much better served than others. The mining companies themselves, some of them have got to grips with biofuel already quite well. Others are more cautious and aware that the cost implications are quite high depending on what market you're in. So talking to some of the fuel producers in Australia recently, a true renewable diesel is currently not yet widely available in Australia, and if you do want it, the costs are up to 2 to 3 times that of a conventional diesel per litre. So there's some quite big barriers to overcome still in implementing bioenergy, and that's aside from the concerns that we have in terms of the overall emissions impact, including the land use change. You know, we have to be aware that biofuels are not necessarily all equal in terms of the emissions reduction that they provide, if you take that into account. Automation can give you a 10 to 30% reduction in fuel consumption. If you're looking at fully automating a large haul truck, it can cost you $2 million a truck. So we're seeing automation obviously getting rolled out a lot more widely around the world, but it does come at a cost. In terms of Scope 1 reduction, electrification of mine fleets is something that's been going on actually for a long time. I think going back to the 1970s at some of the initial trolley assist operations. It's not a cheap thing to install. It has a big implication for overall power consumption at your mine site, and so consequently it could, for many mines, be difficult to implement, partly because they don't necessarily have the power capacity coming into site that they need to do it. So trolley assist has some applicability depending on the mine, but is not necessarily going to be a solution for every operation. And then obviously we have the development of electrified battery electric hydrogen fuel cell fleets. Again, that has power consumption implications for the operation as a whole. We're already in a situation with regard to underground mining operations, whereby if you're building it from scratch, building an electrified mine from the get-go could turn out to be relatively cost neutral in comparison to a traditional diesel fleet. It's less straightforward if you're looking at re-equipping an existing underground mine You may not have the power infrastructure. You may not have the right size heading development, things like that. But right now, when you take into account the advantages you get in terms of things like reduced ventilation requirement, a better working environment for your workforce generally, they're not dealing with a lot of noise and diesel fumes. Electrification of underground is already looking like a very competitive option in some cases. Open pit, we're still waiting to see how those large-scale open pit equipment development initiatives unfold. So that's some of the levers. Another piece of analysis we did recently was to look at the kind of financial materiality of decarbonisation to some of these mining companies. So what we did here was we modelled the potential carbon exposure of each of these businesses, assuming a $50 a tonne carbon pricing regime. And the initial conclusion was that relative to, say, market capital, you're looking at a fairly low number, just as some kind of raw comparison between the impact of carbon exposure relative to the overall company valuation. However, it's probably more useful to look at this after you've factored in a multiple on that carbon exposure financial number, just to make it a little bit more relevant to the market cap, in that you always think of market cap as a multiple of earnings rather than just a straight earnings number. When we do it that way, you see that in the case of some companies, as a relative a number relative to the market cap, it becomes a bit more significant. The point we were trying to get across here was that some of these companies still have quite big exposure and plans in progress, which are highlighted in the green colour there. And if carbon pricing becomes more prevalent around the world, then this does start to have a more significant financial implication to it. And that's it in terms of what I wanted to take you through. I'd be more than happy to take questions on whatever.
A few slides back, this one. Why isn't there more use of carbon offsets?
Carbon offsets are widely distrusted. I think it's probably a good way of putting it. We have a huge credibility problem.
Voluntary carbon credit market.
Say that again, please.
The voluntary carbon credit market has got some questions about it. I've done the carbon.
Is that right?
Whereas the mandatory carbon markets, and actually that nice segue into further question on carbon pricing in relation to the carbon credits.
So just for the benefit of the microphone, thank you. That's absolutely spot on distinction there. So Michael made the point that there's a distinction there between the voluntary and the mandatory carbon markets in terms of credibility. On the voluntary side, we've seen a sudden growth in the number of companies offering offsets. Streamers. Yeah, and we saw a bit of a fad developing there, where a whole bunch of schemes came to the market, which, in retrospect, don't look very high quality. And there's a fair amount of disquiet about what standard do you take in getting comfortable with the carbon credit. The mining companies themselves have realised that they have enough credibility problems generally without doubling down on that by by incorporating carbon credits, carbon offsets as part of their plan too extensively, although there is a general acceptance that when you get out towards that 2050 target, it's going to be unavoidable that you're going to have some emissions you have no alternative other than to offset. So we have this interesting situation, and it was I was at a workshop yesterday run by WSP, and there were some really interesting presentations there, particularly I thought from Isometric, who have obviously seen an opportunity to put together well, I suppose you'd call it a verification and accreditation process that has as much scientific expertise incorporated in it as possible to try and get past that credibility problem. But this is the big issue, it's credibility. But Michael, it'd be lovely to hear what you think about this.
Sure. Just preface, my experience was with one of the Canadian banks when they acquired a carbon credit business and marketer. I think you're right. The issue when for the voluntary market was the accreditation and validation. I think the point, and I tried to bring this up with mine before, where you see the use case would be potentially on their own concessions. If it is underground and you have a concession, you can earmark no deforestation or don't chop down the trees. I think Sinclair had a big issue in Turkey at one of their mines where they said they only had to remove a couple hundred trees, turned out to be more than 10,000. But that could be secured as a carbon offset and used by the company internally, which would be a carbon inset. So that's a little bit of vernacular coming up in the market. But it gets to, I think the larger point is the durability of these net zero targets, at least on the mining side, especially now that we see, erosion of the standards, CSRD, the omnibus, putting those things on hold, the SEC requirements, and a number of banks and asset managers leaving Net Zero Banking Alliance, Net Zero Asset Manager Alliance, and where this might have an impact. Even some of the banks that I've been with that have vacated their ambitions, and if they are the provider, a financer with one of the mining companies, if your bank isn't all that concerned about net zero, why would you be as one of their clients? So that's sort of where the question that I wanted to get to was on the durability. If you're seeing any erosion on the durability of these targets at this point in time and eventually going forward.
At this point in time, no. And thanks for that, by the way, on the offsets. And before we move on from that, that's a very interesting opportunity for the mining companies in that they're big landholders, potentially, using the land holdings they have to provide a credible offset is a huge opportunity to them.
And I think that gets into your carbon intensity, but whether or not they're actually being able to monetize their decarbonation efforts by looking at what you get out of potentially a carbon offset, or the idea behind it is supposed to be if you're not meeting your targets, then you go in and purchase the offset.
Yeah.
And depending on how you account for it. So that's going to be the other part, is whether you're accounting for the intangible costs on your income statement or the move to try to put this onto the balance sheet so that there's actual targets and responsibilities to it. But if you are not taking advantage of the carbon and the value that you get from showing decarbonation, is there a value to the company? The better performers on decarbonization, if that's the case, then you can quantify, get the impact to whether it's coming through on your WACC or other aspects of the risk rating. So I formerly or previously, I used to do and run the ESG risk rating for sustainability, Sustainalytics for the mining, forestry, and steel sector. So I have an idea on aggregating non-financial.
Thanks. So, and your question was, are we seeing some erosion on the targets?
Yeah, the durability of targets are here.
I would say so far, no, that doesn't seem to be the mood music, if you like. But what we do hear is some skepticism, if you like, from the financial community. I wonder whether that is potentially a leading indicator that the mining companies may be expected or potentially even encouraged to row back on some of these targets. But that's where I think other factors also need to be thought about, in that if the companies are genuinely putting together near-term targets that are effectively cost neutral, why would they row back on those if they're actually achievable and the economics make sense? So the more difficult point comes beyond 2030, where you've done the easier scope 2 abatement, but you have this real difficulty in reducing the scope 1 emission. So I think that's the point at which we're going to see some wiggling going on. And interestingly, I think quite a few of the companies we look at have had targets in place now for 3, 4, 5 years that they are coming up to review. So I think the next 12 months, given what else is going on in the world with, Trump tariffs, everything else, is going to be quite interesting. But we're not seeing that erosion yet. But I'm not saying it won't come.
I have another question.
Do you mind if I just take a question from the back end?
One of the decarbonisation leads you haven't shown that the company is divest.
Yes.
I understand that potentially pushing the problem on others, but anything that we are seeing divestment of low quality assets like is that translating to the new owners? Still way that
Question.
So the question was, to what extent is divestment impacting? To what extent is divestment happening, and what impact is that having on company progress towards targets? And obviously that, although we're calling it organic growth, that can also include divestment and M&A. So it doesn't necessarily have to be it doesn't have to be growth. It's probably a bit misnamed there. But yeah, it's a huge factor. Obviously, we've seen quite a few deals happen where there's a big transfer of carbon liability, if you want to call it that. I think in some cases that has happened in a way that has been at least partly driven by the emissions benefit. In other cases, there's also bigger strategic things going on. So I think it's probably fair to say that the emissions component isn't usually the main driver of those divestments, but it does have a big, it is a big factor in some of them for sure, because it has had a big impact. We're getting close to time, aren't we?
I think you could maybe one more question.
One more question.
Do you include Chinese companies in your coverage?
Yeah. China's another really interesting situation in that we have President Xi's latest initiative towards high quality productive forces. I think is the it was a LME week this week in last year in London. There was some fascinating presentations by Chinese entities, but all of them quite regularly plugged this latest idea of high quality productive forces, which is essentially the idea that the Chinese economy and the manufacturing base will be incrementally rebuilt with high tech and sustainability at the heart of it. And I think if you look at everything from solar power production capacity to the way in which, you know, Chinese industry in general is evolving and modernising, you've got an interesting potential decarbonisation story emerging from China, which I thought I, you know, might never say. And obviously they're providing a lot of the technology and equipment that's feeding into decarbonisation more widely. But yes, we do. We cover China. We get good data, and yeah, we do. That's what we do.
Well, thank you, Mark and Ray. Another fascinating presentation for you on this topic. Very interesting point, I think, towards the end on, you know, sort of looking at the comparison on an absolute basis versus an intensity basis on a company by company or mine by mine versus global basis. And, you know, how do you measure that, and which tells you when you're making progress or not? But thank you both again. Thank you all for attending.